Hello, good morning. I'm Avnish Jain. Welcome to the monthly debt outlook from Canara Robeco. First of all, wishing everyone very happy New Year 2026. And we had expected a better start to 2026, but from geopolitical situation, what unraveled was different. In the past few months, we had seen geopolitical tensions subside as the Middle East war between Israel and Hamas entered into a ceasefire, and the initial talks between Russia and Ukraine started on trying to end the Russian-Ukraine war. However, in early part of January, we saw US administration take out President Maduro from Venezuela and produce him in court in US for charges on drug and weapons trafficking. This has created another geopolitical flashpoint in an already unstable world. While the market did not move much on the news, we did see commodities flash up as geopolitical tensions typically lead to higher commodities on risk off. Overall, geopolitical situation is likely to remain volatile as we see what happens in Venezuela in the coming months. While the interim government has been sworn in, it is yet to be established how it will work and how US is going to be able to guide the administration in the coming weeks or coming months. The aim of the US seems to be trying to increase oil supply from Venezuela, but the Venezuela oil infrastructure is extremely bad and it will take years for it to be brought up to par. Coming to economic data, US economic data continues to remain resilient, but inflation is sticky. While the US Federal Reserve cut rates by 25 basis in December 25, the commentary was hawkish, where people expressed concern about the trajectory of inflation in coming months. People thought that inflation could remain sticky in coming months, and rate cuts will be far and few in 2026. If we look at 10-year as a benchmark for sentiment, it has barely moved too much in December. We saw a low of around 4% in December before the policy announcement. Right now, the 10-year US G-Sec bond is between 410 to 420 range and is likely to remain here as market awaits new developments from geopolitics as well as from the US Federal Reserve. Oil prices remain benign despite attack on Venezuela. This is because the oil supply has been more than the demand, especially in the last 6 months in 2025. The OPEC Plus has increased production, which they had reduced in the previous years to counter very low oil prices. Overall, that means oil prices will remain under control, which is positive for India. Gold and other commodities like silver have been going up in the past few months. This was on back of increased geopolitical risks as well as pressure on US dollar because of higher fiscal deficits. Coming to India, Indian macro situation remains good if we look at from the prism of growth and inflation. Growth in first 6 months of financial year 26 was around 8%, with the second quarter showing a remarkable growth of 8.2%. Inflation dropped below 1% in last 2-3 readings. In November 25, the inflation printed 0.7%. Inflation should start inching up now, as the major factor for lower inflation was deflation in food prices, as food prices were much lower in this last year. As per RBI projections, inflation is expected to be around 4% in the first quarter of FY 26-27. Going forward, market sentiment is expected to be subdued. In terms of rates, the 10-year G-Sec remained volatile in the end of 2025. Because of pressures on supply, especially from state government security issuances, market sold off in last week of December. RBI has been trying to support markets through open market operations. RBI governor had announced 1 lakh crores of open market operation purchases in the policy. Subsequently, in the last week of December, they further announced 2 lakh crores of OMO purchases. This brought a minor relief to the sell-off. But again, at the end of the month, it was announced that the state government security supply would be much higher than what market expectations were. Markets again sold off a bit in early part of January, but with the continuing market operations purchases by RBI, we expect that market should be supported around these levels. Overall, we expect 10-year GSEC to be between 6.55 to 6.65. Corporate bond market also was lackluster, especially this happens because the year-end the markets are pretty illiquid. We should see some return of activity in the first half of January. Going forward, factors impacting markets would be especially linked to geopolitics. We have seen supply pressures also increase from local bond supply, especially linked to state government securities. The next major policy events like the Union Budget on 1st February, followed by monetary policy around 5th, 6th of February, should be the next major events for bond markets. While markets don't expect any major change in borrowing from the government, they will closely look at the borrowing numbers and the fiscal deficit targets which are taken up by the government for financial year 27. From RBI perspective, there is an expectation of 25 basis more rate cut as inflation has been undershooting target, for which RBI also has taken the reason for cutting rates in December 25. However, considering the global situation, RBI again may have to take a hard look at what kind of policy decision can be taken, considering especially also that rupee has been under pressure because of one, the US trade deal is still not happening and it is getting postponed. Second, because of large outflows on FI, especially when we look at equity FI outflows last year. Rupee has been under pressure since December 25 when it crossed 90 to the dollar. RBI has supported rupee through its market operations, but as RBI always states, it due to manage volatility and not to give any direction to the rupee. Rupee continues to be around 90 to the dollar level. Going forward, we do expect RBI to cut rates in February policy. There is market expectation. But again, considering the geopolitical situation as well as rupee depreciation, RBI policymakers may have to make a hard decision of whether to cut or not to cut rates in the next policy meeting. Overall, markets are expected to remain subdued. We do not see any major drop in yields, considering that we are probably at the end of the rate cut cycle. Globally also, apart from the US Federal Reserve, most of the large central banks have been on hold, and probably one or two central banks are looking to cut rates further. 2026 would be a year of policy pause, but with enhanced geopolitical tensions, markets are expected to remain volatile. We continue to watch markets on a weekly and monthly basis to a certain direction. Going forward, how do investors position themselves in these markets? We believe that as rate cut cycle comes to an end, duration play will be limited in funds. To that extent, we believe that money market funds and shorter duration funds like short duration fund, corporate bond funds and banking PSU funds may perform better compared to duration funds. Investors may choose to invest in funds like low duration fund, short duration fund, corporate bond fund and banking and PSU debt funds. As usual, investors should look at their risk profile and their investment duration before investing in debt funds. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.